Every business owner thinks lenders judge them when they apply. That's just not true. This isn't personal. This is business. Most judgments are already made long before an application exists, based on nothing more than how your bank account behaves day to day. Your bank statements are telling somewhat of a story about your business, whether you like it or not. And most owners have never read that story from a lender or an underwriter's perspective. Today, I want to show you how underwriters actually interpret your bank activity in the first 60 seconds and why businesses with solid revenue are still quietly getting filtered out before they even really get a shot. Here's what underwriters actually read. When lenders review bank statements, they're not scanning for success. They are scanning for risk behavior. They're not asking, is this a good business? They're asking, does this business behave in a predictable, controllable way that's going to get us paid back? Modern underwriting systems categorize transactions immediately. Deposits, withdrawals, credits, debits, timing, frequency, and balance stability, the amount of money you keep in the bank, are all interpreted as signals to lenders and underwriters. And within moments, the system already has a working profile of how your business operates under pressure. So, let's talk about the signals. Signal number one, liquidity discipline. One of the first things underwriters notice is whether your business maintains breathing room. Overdrafts and insufficient fund fees, as well as not keeping a lot of money in the bank, they're not viewed as a mistake. They're interpreted as evidence that the business operates without margin. So even if you're paying all of your bills on time, even if everybody is getting paid and you just transfer the rest of your margin out into another bank account, they're going to see that you can't afford the loan because they use your average daily balances as a measurement of affordability. So you want to keep money in the bank as padding. Even just one isolated event like a negative day or an NSF may raise a question, and repeated events like this establish behavioral signs. From a lender standpoint, a business that regularly touches zero in their business checking account is not unlucky, it's structurally tight. And that matters because lenders are not lending for today, they're lending against future stress. Signal 2. Revenue consistency. Next, the underwriters look at how money enters your account. Consistent deposits signal repeatable revenue. Irregular spikes and valleys signal volatility and risk. Large deposits that materially exceed your normal monthly inflow are not automatically bad. I mean, you're making more money, but they must be explained. Without documentation and invoices or contracts and stuff like that to back it up, they're treated as non-operating or borrowed funds. The goal here isn't for them to see massive growth. They like that, but the real goal for them is reliability. A smaller, consistent business, believe it or not, often underwrites better than a larger, erratic one. Signal number 3, hidden obligations. Underwriters are also looking for financial gravity. Recurring withdrawals that resemble debt payments but do not appear on a credit report raise immediate questions. These often point to short-term credit facilities, merchant cash advances, or informal repayment agreements with friends and family. When these appear without disclosure, lenders assume risk is being understated. This is one of the fastest ways a file loses momentum, when they find out that something is in your bank account that you didn't put on your debt schedule. Not because the business is failing, but because transparency is unclear, and now, quite frankly, they don't trust you. Signal 4, cash flow under pressure. Profit alone is not the metric that they look for. Underwriting wants to know how your business performs after obligations, not before them. So most lenders look for at least $1.25 in operating profit for every dollar of debt payment that they're going to write for you. That buffer is what absorbs delays, repairs, and accounts for slow months. A business can look strong on paper and still fail this test if there's no margin left once the bills are paid. Signal 5, reserves and stability. Finally, underwriters assess how your business prepares for disruption. They look for idle cash, not excess cash. Funds that sit untouched long enough to prove they're not borrowed. They review average daily balances to see whether your account is stable or reactive. Businesses that oscillate between high and zero balances are treated differently than businesses that hold steady ground. So try and keep at least 10% of whatever you make a month in the bank at all times to show them that you have high balances. Stability signals control, and that is why it matters. None of these signals are moral judgments. They're probability indicators. So again, not personal. This is business. Underwriting is not trying to predict success. It's trying to avoid failure. Once you understand this, the process becomes less intimidating and more mechanical and methodical. You can beat the system. Most businesses are not denied because they are weak. They're denied because their financial behavior is noisy. So here's what you can do next. The advantage goes to owners who review their business the same way that lenders do. If you want to understand what your bank statements are communicating to lenders before you ever apply for funding, I have a link for you to walk through the process with me and my team personally. We'll talk through your activity from an underwriting perspective and tell you exactly what's helping you, what's hurting you, and what needs to change before you submit anything. Because once you know how your business reads on paper, you can decide whether to apply now or prepare intelligently. So click the link in the description and schedule a call with my team.